Hey everyone, today I want to show you how I generated 229% annualized profit with very minimal risk on my recent Nike trade using double calendar and double diagonal option strategies. I entered the trade on the 10th of February, and at that point Nike was trading at 122 and I had no idea which way the price was going to go, and that didn't really matter because what mattered most was the volatility. The volatility was very low, and earnings is coming up on the 21st of March, and volatility tends to go up as earnings approaches and drops right after earnings. In case of Nike, you can see this beautiful pattern that every single time earnings is approaching, volatility goes up, and then right after earnings, volatility drops. And then it's just a beautiful pattern every quarter, every 3 months, and you can take advantage of this pattern by applying the strategy that I'm going to go into more detail. So in this diagram, I tried to explain to you how double calendars work and how you can take advantage of it when earnings is approaching. So like I said, before earnings, volatility goes up, and that pushes the option values up. However, on the other hand, the passage of time forces the option values down, but the bigger force, the stronger force is definitely the volatility. So when the volatility is low, you can buy options. You can buy, let's say, a strangle, which is buying a put option and buying a call option for relatively cheap, and you can also offset some of that cost by selling a strangle that expires before earnings. So you can see that the green line is diminishing quite nicely, and in fact it goes down to zero. Well, this is obviously just a theory. It goes down to zero before earnings, but the red line retains most of its value. So if you spend X amount on D1, which is your strangle that you purchase, then you can offset some of that cost by selling a strangle, let's call it C1. And then when you close it, well, you want to close it before earnings because the strangle that you sold will lose most of its value. So let's say the D2 is going to be quite low or quite minimal, while the strangle that you purchased that's expiring after earnings will retain most of its value. So the C2 will be still relatively high. So if your C1 minus D1 plus the C2 minus D2 is a positive figure, you profited from this trade. The only way you can lose money on this trade if there is a huge movement to the upside or to the downside. But generally speaking, this is a relatively safe strategy and your max loss is capped. So let's see how I applied this strategy on my recent Nike trade. So when I opened the position on the 10th of February, the trading price was around 122. So I purchased a 117 put option and a 125 call option. So I purchased that 117, 125 strangle, and I also sold the same strangle but expiring much sooner. That trade cost me $679. So that was my absolute max loss, but I knew that I'm not going to lose that entire amount because I had more than a month to keep rolling my position. The strangle that I sold was a weekly strangle, so it expired pretty much within a week. So that gave me the opportunity to roll my position and collect additional premium and reduce my cost basis, which is exactly what I did. A few days later, 5 days later to be exact, I rolled out my short positions to 120 and 125. So you can see that I went up from my put side, I went up to 120, and that gave me an extra $95 credit. So my cost basis went down from $679 to $584. At that time, the share price of Nike went from 122 to almost 128. So this was a losing position at that time, but I had a feeling that it will have to come back down because that was quite a rapid move upwards, and the market conditions just didn't justify that. So from this point onwards, I had a 120, 120 straddle short position, and I still had obviously my long position at 117 and 125. I kept that position for another week, and then I rolled 1 week out, and I kept my straddle at 120, and I received an additional $154 credit. So my cost basis from the initial 679 is now down at 430, and I kept this position for another few days before I decided to roll out another week, and I collected an additional $139. So my cost basis went down to below 300, and because the share price was going up, I wanted to push my call strike up to 122 instead of keeping it at 120. But then when I saw the weakness in Nike, I rolled down my call strike to 120, and I received $47 extra credit for it. So my cost basis went down to 244, and I was able to exit this trade at 244. So once again, I purchased this deal for 679, and I exited at 244. So this trade worked out really beautifully, but the most exciting part of it was that it was quite predictable, and I had a very, very minimal risk in this particular trade because of the way options work and the way volatility influences option prices. So you can certainly take advantage of this information, and I hope you find this useful. I hope I explained it properly so that you can replicate this type of strategy and start making money trading double calendars and double diagonals. If you have any questions, feel free to reach out to me via my website taekunitos.com, and you can also leave a comment. And if you like this video, hit the like button and subscribe to my channel, and thank you for watching. I'll see you on the next video.